You're listening to Insights with Philip Wilson, where the discussion focuses on how to maximize Social Security benefits. Considering there are 567 ways to file and 3,000 rules for filing, it's no wonder that 90% of those who file for Social Security do not receive their maximum benefits. Listen in as Philip Wilson, who is certified in Social Security claiming strategies, outlines what you need to know to get the most from your Social Security benefits.
Welcome to the show. Today we're going to continue our discussion of what to do financially after the loss of a spouse. This is part two. We'll continue the discussion from last week, talking about the common problem areas that create the most stress, that help people, cause people to be the most overwhelmed in that situation. Loss of a spouse. I just can't even begin to understand what's involved with that. But these financial areas are important. And they're areas that people overlook, and they create a lot more stress for themselves because they overlook them. This is one of my favorite topics to speak on. It's one I love to speak at, particularly at the churches and the sport groups. In fact, we actually have a DVD associated with this message. All of our message, all the radio shows are up on our website. You're always welcome to listen to those again. But this one in particular, we've actually produced a separate DVD that you can give out to your friends or family or anybody that might be interested in this type of message. So if you would like that, you can just call the office, talk to anybody there. We will mail a DVD to someone or mail it to you. You can give it to them. There's no obligation, no cost whatsoever. We're not going to call the person or anything along those lines. We just want people to have this information. We want them to know the common problem areas that create the stress and just try to do our part to help them through an overwhelming time. Just a quick summary of last week. We talked about several different issues. One of the things we talked about was the possibility of having life insurance, but not being aware of what the companies or the agents, how do you find out if you have some different insurance policies? There's also several different areas that contain policies that a lot of people don't even realize to look. I mentioned the Medical Information Bureau, the MIB. The Medical Information Bureau is a third party that houses insurance information on people. If an application was made to an insurance company, they will have it. They will do a search. They're not necessarily going to tell you whether or not the policies are enforced, but at least they give you a starting place of someone to contact. Other places to look: trade associations, fraternal groups, employers, labor unions, banks, credit cards, all these. If you have a checking account with a bank, there's probably a small insurance policy associated with that. If you have a credit card with a company, there's probably a small insurance policy associated with that. Trade unions, fraternal groups, employers, labor unions, membership generally will have some sort of benefit associated with life insurance. So I encourage you to make those phone calls to see whether or not there's any kind of benefit there. Mortgage cancellation insurance is also another area that I mentioned before. A lot of people have purchased mortgage cancellation insurance when they took out a mortgage years ago and forgotten about it. And you can determine whether or not that policy is in place by looking at your mortgage statement, and there will be some sort of deduction. There'll be a small deduction, but there'll be some sort of deduction on there for insurance, and it will say that. And you can give them a call and contact them to see what paperwork would be involved for filing for that claim. Some of the other ideas that I mentioned was not using a personal checking account to receive bills from an estate or pay bills from an estate or receive income from an estate. All these transactions need to be separate, and they need to be in a specific estate account that's set up with the bank. Very, very, very important. Some of the other areas that I want to cover today, one of those areas is with a reverse mortgage. A lot of older people have taken out reverse mortgages as part of their retirement. And I'm actually a big advocate of those types of things. We've talked about that in other shows relating to income for retirement and so forth. But the biggest issue here is that if you are a surviving spouse and you're on the reverse mortgage loan and on the title, you generally will have the option of remaining in the home. So if you're a surviving spouse, you're on the loan, you're on the title, you will have the option of remaining in the home. That is very standard for a reverse mortgage. Reverse mortgages are triggered by the last person on title leaving the home for 12 months or more or dying. So in general, if you are on that mortgage or if you're on the title, you're in good shape. The problem is if you're a surviving spouse and you're not on the loan or not on the title, there's a problem. And in recent years, there's been some remedies for this situation, but this is something that you need to get some help for and to look into, because you may have a problem. That loan might become due and payable if you're not on the title, and you may need to refinance it to get rid of that lien in order for you to stay in the home. So I only want to encourage people in those types of situations, if you're not on the loan or if you're not on the title, you need to get some help to look at this. And normally when someone is not on the loan, it's because they weren't 62 when the loan was taken out, which is one of the requirements for a reverse mortgage. Both parties have to be 62 or older. So sometimes the loan is only done in one person's name, or the title of the house is put in one person's name for that very reason, because one spouse is 62 or greater, the other spouse is 62 or younger. And in order to qualify for that, that's what they had to do. But there's several things that need to be dealt with. Reverse mortgages in recent years did deal with this issue very effectively. Some of the older mortgages, you could have a problem. So you need to be careful about that. Let's also talk about Social Security. As most of you know, if you listen to a radio show, you know Social Security is an area that I advise people in quite a bit. What are some of the rules associated with Social Security and survivor benefits? Well, the biggest rule is that you're not allowed to keep both Social Security benefits if somebody is deceased. You're only allowed to keep the higher of the two. And this comes as a big surprise for a lot of people. A lot of people going into retirement are dependent upon both of those Social Security benefits. They don't recognize that they're going to lose one of those benefits if somebody passes away. And you're only allowed to keep the higher of the two benefits, but not both. Now, there are some widow benefits associated with Social Security, and this is where the greater of the two benefits comes into play. The widow benefits are available to married couples who've been married for 9 months or more. So if you were married for 9 months or more, and there are some exceptions to that, there's a military exception to that, and there's also an exception for an accident. But if you were married for 9 months or more, you have the option of filing for the higher of the two benefits as a widow benefit. So if you were married and there's two Social Security benefits here, and the deceased is the higher Social Security benefit, you could actually refile for that benefit, have it continue for you as a widow benefit if it's the greater of the two benefits and you've been married for 9 months or more. Now, the biggest question that I generally receive with widow benefits is what happens when you're remarried. And there's some unusual rules associated with that I just want to cover very quickly. Some of you that listened to the other broadcast about Social Security, such as a divorce benefit, would know that you need to be single. If you're remarried, you don't have a divorce benefit anymore. Well, that isn't necessarily the case for a widow benefit. Widows can get remarried, but they have to be remarried after age 60. If they were remarried after age 60, they're still available. The widow benefit is still available to them. If they were remarried before age 60, that benefit is not available to them anymore. This is very, very important. What this essentially means is if you were remarried after age 60, you then have a choice. And the choice is that you could file with the new husband or the new wife, or you could file under the widow benefits, whatever the most beneficial would be for you. And so the easiest way to look at this is it all comes down to earnings history. And it all comes down to the earnings history of the deceased or your current husband or wife, and which is greater. And one way to look at it would be that if you were married to a brain surgeon and that brain surgeon passed away, and then you got remarried to a teacher, you probably would want to file for the widow benefits because the income of the brain surgeon is going to be higher. But if you were married to a teacher and that teacher passed away and you got remarried to a brain surgeon, you're probably going to want to file for spousal benefits because your current spouse is going to have the higher income history. And it really is as simple as that. But where people make the mistake is that they don't realize that all of these things they're available. All of these things they can file for. And they just don't realize that they have these choices. And the Social Security office does not let them or does not notify them they can file all these different ways. And that was a big theme associated with the series for Social Security, that all these different filing methods is generally where people make the mistake. When people leave money on the table for Social Security, it's because they just don't know that they should file one way or another. And unfortunately, no one let them know that they could receive more money by filing this way or more money by filing another way. And that's why so many people make mistakes. People get remarried in this area and they don't think at all about the widow situation. They don't think at all that they might have the option of filing that way. It just doesn't really even occur to them. And it may be a benefit, it may not be a benefit. But under the widow situation, you are allowed to keep the greater of the two benefits. You can refile for the higher of the two on your spouse, the deceased spouse, if you were married for 9 months or more. That is the widow benefit, essentially. So you're receiving that higher benefit as a widow benefit. But you're not able to keep both. And I know that's something that people don't really understand. And we'll continue with that when we come back from the break. Welcome back. We're talking about Social Security for widows. Just to summarize very quickly, you are not allowed to keep both benefits. You're only able to keep the higher of the two benefits as a widow benefit. That generally is the mistake that most couples make, is the assumption that both of those benefits are going to continue. Most people realize that they could file for the widow benefit, but they also think that their own benefit is going to continue, and that's not going to happen. It's going to be the higher of the two, but not both. So if the higher of the two is the deceased, you can refile for that as a widow benefit and have that continue, but you're going to lose your own benefit. But that is what the widow benefit rule is. The other area that I see the mistakes in are not recognizing that remarriage has an implication on the widow benefit, positive or negative. A lot of people assume that when they're remarried, they don't have the option of filing for the widow benefit, which is not true. If you get remarried after age 60, you do have that option still. Or you have the option of filing under the new husband or wife. You have to choose which one is the best way for you. And if you need more information on that, I encourage you to go to our website. I actually covered this aspect in great detail under the Social Security series, and you can go to ssmistakes.com and listen to those broadcasts. The other area that I see a lot of mistakes in with respect to widow benefits is not understanding the changes associated with the 2015 Social Security changes. So I just want to talk very briefly about that. In 2015, Social Security changed greatly. And the concept that was put in is something called deemed filing. And what deemed filing means in the Social Security world is that you are deemed to be filing for all Social Security benefits that you're eligible for when you file. So you don't really have the option of picking and choosing different benefits. When you file, you're eligible for everything you're eligible for, whether you want it or not, or whether you receive it or not. Now, for anyone that heard the series on Social Security will know that we talked about this at length, and we talked about exceptions to that. Exceptions to where we could receive a benefit a certain way and then come back and file for another benefit. Well, I just want to mention the exception to that associated with the widow benefits. Widow benefits are eligible for you to receive as early as age 60. And if you receive those, you actually can come back and file for your own benefit at age 70 and still have that option. Now, in general, under the new rules, under the 2015 rules, you would not have the ability to do that. Once you file, that's it. But they have some exceptions associated, and they're good exceptions. Anybody who's going through this type of situation deserves a little bit of a break, and this is a great break. So you actually could file for a widow benefit as early as age 60 without jeopardizing your own benefit and jeopardizing the 8% increases that the Social Security Administration make to your benefit between full retirement age and age 70, which is very, very significant. The second type of widow benefit that I want to cover is the divorce widow benefit. And divorce widow benefit is very similar to a regular widow benefit. The obvious difference is that it's for divorced couples. So the requirement here is that you were married for 10 years or more. It also has a requirement that you're not remarried before age 60. But the amounts for the widow benefit are much, much greater than the regular divorce benefit. And so you do have the option of receiving that benefit both ways. You could receive it as a divorce benefit, or you could receive it as a divorced widow benefit. If you were married for 10 years or more, you're not remarried, you will have the option of receiving it as a widow benefit or as a divorce benefit. I do see a lot of people who receive a divorce benefit for a number of years. The person passes away. They don't realize that they could refile and double their benefit, because a widow benefit is twice as much as a regular benefit. So a divorce benefit is just 50% of whatever the ex's full retirement benefit is. A widow benefit is 100%. There's also some deemed filing rules associated with divorced widow benefits that I just want to mention as well. Very similar to filing for the widow benefit, you still have the option of filing for the divorced widow benefit and still coming back and receiving your own benefit at age 70. The rules are a little bit different. You do have to wait till your full retirement age to do that, but you do have the option of filing for a divorced widow benefit while still coming back for your own benefit at age 70. The difference is that you could file for a regular widow benefit as early as age 60. You don't have to wait until your full retirement age to file for that. So that is a great benefit for folks. It's another situation that a lot of people are planning on waiting till age 70 to file for the Social Security benefit, and they don't realize that they could receive the divorced widow benefit at their full retirement age while still working, while still planning on coming back at age 70 and filing for that benefit. Some of the other areas that I just want to wrap up on for this session and this time today is I want to talk a little bit about taxes, and in particular taxes on assets that are left in the estate and passed along. This is a pretty complex topic. I just want to hit on a few things. One of those things is what we call a stretch IRA. And a stretch IRA is not a new concept. It's simply a wealth transfer method that allows you the potential of stretching your IRA over future generations. And what happens is if you name your beneficiary to an individual, that individual has the option of continuing that IRA without having to pay taxes. Because if you haven't named the individual, they're going to have to pay taxes on that IRA when it's passed along to them. So it allows you to name an individual and that person can become a successor owner of that IRA and stretch that IRA over future generations and avoid taxes. It's a really great thing. It's a great benefit. The real benefit is that it allows beneficiaries to defer paying taxes. It allows account balances to continue to enjoy the tax-free growth, tax-deferred growth, as long as possible. It is a great thing for everybody to do. It just has to be set up initially before someone passed away in the correct way. And it has to be set up by naming an individual as the beneficiary. One of the other areas that I want to mention is some of the taxes associated with variable annuities. A lot of people don't realize that variable annuities cannot be stretched. In contrast to stretch IRAs, we have the option of leaving someone an IRA and continuing that without having to pay taxes. So we can take advantage of that growth. We cannot do that with an IRA. With a variable annuity. What most people don't realize is that when you leave a variable annuity, you will pay income taxes on all of the gain associated with that annuity. So if that annuity was purchased, for example, for $50,000 and it's worth $100,000 when the person passes away, you will pay tax on the difference. So you will pay tax on $50,000, which is the gain. And that is ordinary income. And this is a big tax burden for a lot of people in this type of situation, because they are not expecting to get a 1099 for $50,000. There's no real way to get around this. This is a concept we call income with respect to a decedent. There's really not the planning for minimizing this has to be done before the person passes away. There are some things that you can do there that are a little bit beyond the scope of this session today, the show today. But I just want to mention it because I don't want people to be surprised by that. Another thing that people don't realize associated with the taxes on assets or the step-up, what we call step-up in basis. And what a step-up in basis is that when you leave assets such as a stock or a mutual fund, the basis, which is the fair market value on the day in which the person passes away, it becomes your tax basis. Most of you are probably familiar with how we pay capital gains on assets. So if you buy a stock for $10 and you sell it for $100, the difference between those two, $90, you're going to pay capital gains. Well, with a step-up in basis, when a person passes away and leaves that stock to you, your basis is what the fair market value is of the stock when they leave it to you. So in this situation, if they leave you a stock that's worth $100, your basis is $100. So you're only going to pay tax on whatever gain is above $100. And this is a huge tax break for people in this type of situation, because when you leave stocks in this way, you're going to avoid the taxes associated with the buildup over the years of that asset. And I see people all the time who have purchased stocks many, many, many years ago. They have a large tax consequence if they sell them that's totally avoided if they leave that to their spouse or to their children as a step up. But that pretty much wraps up the discussion of what to do financially after a spouse. Again, if you'd like additional information here, please call the office. We'll be happy to provide you a DVD. I actually have some written reports that are a little bit more detailed, even more information than what we've covered in the last 2 weeks. So feel free to call the office. Just tell anybody what your address is, and we'll mail that to you without any kind of obligation, and we're not going to call you or anything like that. I do want to wrap up today by just setting up the topic for the next few weeks. This is a pretty important topic to me. I'd like to do a series on a book, and it's a book called Finding Peace in Life Storms. And Finding Peace in Life Storms is a book that my wife and I wrote in 2012 and 2013 in response to a series of trials that we had in our life. And we have a study associated with that we teach at some churches and small groups. And I'd like to do a series about that. So if you need some encouragement, please come back for that, and I think you'll find that the topic and the discussion would be very encouraging to you. And I'll look forward to talking to you next week.
You've been listening to Insights with Philip Wilson, an Alabama registered investment advisor. Learn more by visiting his website at ssmistakes.com or by calling 205-868-9297.